Clients and friends. My name is Blaine Anderson. I'm a certified financial planner and an accredited investment fiduciary with Bander Wealth Management. If you're receiving this video, it's likely in preparation for an upcoming client appointment or perhaps as a Q3 or Q4 update. What I would like to do is share with you a few things that we are hearing, seeing, and observing in the general market and in the world around us, as well as share with you a few firm updates and things that we are doing here with Bander Wealth Management on behalf of clients from a strategic financial planning standpoint and also from an investment portfolio and an investment management standpoint. I will share my screen with you, and I'd like to take a few minutes. I invite you to uh, watch and to stay with me as I share some updates and things that we're finding pertinent and relevant to clients at this time. Now, you're also receiving this link. You should be able to fast forward if you'd like me to move along a little more quickly, but I look forward to sharing with you some things that we're seeing and in preparation for perhaps an upcoming update or client appointment. Now, what I'd like to do is share my screen with you. And as I mentioned, these are things that are expected for you to receive during Q3 or Q4 of 2024. And what I'm going to do is cover a couple of items here. Number one, a general overview of the markets and the economy. Number two, I'll give you an update on some of the things that we're doing from a supervisory standpoint with client accounts. And then lastly, a few year-end strategic financial planning items. So let's jump right into it. Number one, as far as an overview of the market and the economy, the US economy has continued to grow in the first quarter of the 2024 calendar year at a 2.6% annual rate. Now, that's a slowdown compared to 2023, but it's still good compared to the past couple of decades when the average growth rate was right around 2%. And even the Atlanta's Fed model is tracking at a 3.3 annualized growth throughout the remainder of this year here in 2024, which is above the 20-year average growth rate of 2%. So things do appear to continue to march forward from a general economic standpoint here within the US economy. Now, a few key takeaways. This is as of the May 2024 meeting, but the Feds have voted to hold rates steady at 5.25 to 5.5% for a sixth consecutive meeting and announced a slower pace of quantitative tightening beginning in June. So the timing of rate cuts will likely depend on the inflation growth data that will take place between June and September in those meetings. So I know we were anticipating maybe a reduction in interest rates, and so far we haven't seen that yet. We may still see some through the remainder of the year, but the Feds have mentioned or given implication that they're not expecting to do it at such a fast pace or to lower rates here anytime too soon, you might say. Now, a few key takeaways from an investment standpoint. We're noticing that a lot of investors, they have high amounts of cash sitting on the sidelines. And so you might even ask yourself, how much idle cash is sitting in your checking and savings accounts? Every week at Vanderwealth, our advisory team compiles a list of the highest US Treasury and CD rates from banks throughout the United States. If you'd ever like to see those rates or compare those rates to what you're currently receiving, please let us know. We can pull from banks all throughout the country and invest in CDs and US Treasuries throughout or within your supervised accounts here at Vanderwealth Management. And so our team can provide an analysis to confirm that you're receiving the highest rates on your cash. And especially with interest rates still being high, we definitely want to maximize that so that it's not being eaten up by inflation. So please know that's one item that we can easily and would happily share with you. Now, a few things from a Vanderwealth portfolio update. A couple things. These are common mistakes that we see amongst investors. And one of the things that we expect to be able to help you overcome or with individually. So, three items. Number one, trying to time the market. Two, getting caught up or focused on the headlines. And then lastly, number three, chasing past performance. So, allow me to share with you a few details on why I bring this up because these mistakes can not only reduce and cut into your returns and your opportunity for return, but can also create unnecessary anxiety. So allow me to explain. So, number one, investors may be tempted to try and cash out of the stock market or avoid a predicted downturn. This is very difficult to do. Nobody has a crystal ball. And so, one thing that we share is that accurately forecasting the market's direction to time when you're going to buy or sell or come in or out is really nothing more than a guessing game. So, one thing that we seek to do here at Vander Wealth Management is to use a mix of investments in your account that allow us to stick with the stock market and our allocation within the stock market for a long term. That way, we can ride out the ups and the downs. And then, secondly, we use and complement that stock portfolio with what we consider to be an income portfolio. And that income portfolio is one that can help level out those returns. It's also money that you can draw on if you're either regularly receiving uh, distributions or taking withdrawals from your account, or if you have an upcoming expense that you may have or incur. So we use our Bander custom income notes. These are a great vehicle and part of that income portfolio. We use real estate. And then, especially with the US Treasury and CD rates being as high as they are and our ability to shop them throughout the country, that's part of this income portfolio. This helps us to not get so caught up in trying to time the market, but really ride out some of the ups and downs. And here's what I mean by this. If you look, and this goes back to 1998, a 25-year period, and it says, hey, $1,000 invested in 1998 would be worth $6,356. That's great over a 25-year period. Now we know that that 25-year period has had a lot of ups and downs. And if I was trying to time the market, look at the difference in my returns if I would have just missed the best week in the market over that 25-year period. Instead of my total return or my total account balance being $6,356, it would be $5,304. So over $1,000 difference by just missing the best week in the market. If I miss 1 month, you can see the difference. If I were to miss three of the best months over that 25-year period, my return from $1,000 would be 4,480 instead of 6,356. And then look if I would have missed 6 months of the market and been on the sidelines over this 25-year period. You can see how much that affects the total return by mistiming, or in other words, trying to time the market. So staying invested and focused on long term helps to ensure that you're in position to capture what the market has to offer. So that's why we like to break up the portfolio and say, here's our stock market investments, and we're going to plan on being in them for a period of time. Yes, they are liquid, but we're not getting into trying to time the market. And then we feel like we have some very good solutions for the income portion of the portfolio, which could also be referred to as the non-stock market investments. Now, a couple of things. The second big mistake is focusing on the headlines. And I'm sure we all, as we watch the news and listen to the media, it's easy to allow emotion into the thought process and the decision-making process. This is our goal at Vander Wealth Management, is to help remove some of that emotion. So here's an example. Many of us, we hear and see about the Magnificent Seven, Google, Amazon, Facebook, Microsoft, these companies that get a lot of attention and have real high performance. And that's it isn't true, but it's also driven by a lot of media attention. And so here's a slide that I thought I would share. This shows companies that before joining the top 10 largest uh, in the US with their annual performance, you can see what it is. And then once they start getting a lot of media attention and hype, look what happened after they joined the 10 largest companies. They failed to outperform the market after previously being in the top 10 for performance. So we don't want to use the media and the news outlets as our source of information. It invokes emotion, and then also it's usually past the point. So that's mistake number two. Now, mistake number three is in chasing past performance. And of course, this is one of the indicators or one of the things that we look at, but it shouldn't be everything. And I just wanted to show this main bullet point that research shows that most funds ranked in the top 25% based on 5-year returns didn't remain in the top 25% in the next 5 years. So the reason I share this is we really want to stick to the fundamentals. We're looking at the balance sheet. We're looking at their earnings per share. We're looking at key economic indicators and business indicators for businesses. But you know what else, most importantly? We're looking at just general stock market investments. And so here's one last piece that I'm going to share on this. With companies that finished in the top 25% the previous 5 years, you can see what percentage of them remained a top ranked fund the next 5 years. And so you can see it's very difficult to maintain that. So that's why we rely less on what we're seeing and hearing in the media and more of what we're seeing just overall with the market. So recap those three common mistakes: trying to time the market. We want to avoid that. Focusing on the headlines, not letting that be our primary driver or source of information, and then chasing past performance. As I mentioned, it's very difficult for companies to maintain that performance. If they were 5 years in the top percentile, it's hard for them to then stay in that top percentile in the next 5 years. So, how do I and you avoid these common investing mistakes? Three things: invest in a diversified portfolio of stocks. And you'll notice with Bander in our growth portfolio or our stock market portfolio, we're going to invest in a diversified portfolio of stocks and index funds. Then number two, invest in an income portfolio to match upcoming expenses. So for example, if you're making regular withdrawals, we can forecast. We know what those systematic withdrawals are going to be, and that helps us to allocate a certain portion to your income portfolio or your non-stock market investments. And then lastly, to stick to the plan. There's a reason why we have this plan in place, and we need to stick to it through the highs and the lows. So, a couple of things. This is our Bander Wealth playbook, if you will. And this is in relation to the growth portfolio, or what I'm referring to as your stock market portfolio. So, as many of you know, when you buy a stock, you're buying a fractional ownership in a public company. And then you or us, as the stock owner, we can benefit alongside the company. And then we're usually compensated as an owner or a fractional owner of that company through dividends that they may pay out to shareholders or an increase in their share price. So now, many times people will ask, well, which stocks should I buy? And for us, a simple answer is all of them. A reasonable allocation in all of them. And that's why we like index funds. So, said another way, buy a large number of companies that are invested in the US and abroad, some that are big, some that are small, and that sell products within a variety of different types of industries. That gives us good diversification within our stock market portfolio. So, why do we want to have the stock market or stocks in our portfolio? It does help to maintain purchase power, to grow wealth, and to stay out in front of inflation. And so, oftentimes for us as certified financial planners, one of the biggest concerns that we hear from investors is outliving their money. Well, we know that your money loses value over time due to inflation, and that's called the loss of purchasing power. So, investing in stocks for a long period of time has historically been a way to have your money keep up with inflation. And I know I was at an educational conference recently, and they talked about the single most powerful wealth generating tool known to the history of mankind has been the stock market. It is a powerful tool. And I know that sometimes it can create anxiety or angst, and we understand that. And so that's why we feel that not trying to time the market, having diversification in the market, having accurate expectations can really help ride through some of those highs and lows. And that's a big part of what we do and we expect to provide to you and on behalf of our clients. So going back to this, our wealth playbook, if you will, if you look at this shows over the long term what the general stock market has done. And this goes back over 70 years. And what it is it shows a 1 year what a maximum return has been and what an average return has been for the market over a year. And then also what one of the worst years has looked like. So as you can see, the longer that you can plan to stay in the market and accurately time and manage the portfolio, the better off you can be. And so really, if you look at even over a 10-year period, the maximum return being 19.1%, the average return being 10.57 and the minimum return being -2%. And that's over a 10-year period within the stock market. So there is some power behind utilizing this particular asset class and having it part of a well-managed portfolio. So this is one of the things that we do as part of your portfolio with Bander Wealth Management. Now, what have some of these past declines in the stock market taught us? This is some good data here. So number one, the stock market declines are the last thing investors want to experience. And I hear and see that a lot, and I can understand, but they are an inevitable part of investing. We do see pullbacks from the market. I'm going to provide a little bit of historical background to help put these stock market declines into perspective. I like this data. And so there's a few different types of declines. Since 1953, we show that declines have varied widely in intensity, in length, and in frequency. And so in the middle of a decline, it's nearly impossible to tell the difference between a slight dip and a more prolonged correction. But here's what the data show. So this goes back, this is over 70 years, and it shows us the types of declines here to the left. So whether it was 5% or more, 10% or more, even 20% or more. And we can see the average frequency. So you can see a decline of 5% or more in the market can happen on average 3 times a year. Now, a 15% decline in the market will happen about once every 3 years. And then this next column shows the average length. And then this to the far right shows us that last occurrence. And so I find this to be very useful. We do know that market declines are going to happen. They're corrections. And really, there's an argument that can be made that oftentimes those are helpful to the market. It kind of pulls everybody back down to reality. It creates buying opportunities. So, but it's difficult to time. We don't know how long they're going to be. But with this data point here and these numbers, we get an idea to understand that they do occur. There are recoveries, and that it's very difficult to remove the emotion or to know which type of correction we're experiencing when we're in the midst of it. So that's why what we want to do is have time periods that we know that we're not going to need to access that money. And that's why we would counter or complement your growth portfolio, your stock market portfolio with your income portfolio, and what we do here at Bander Wealth Management. So 4 lessons that we've learned from these market declines is that no one can predict consistently when the declines will happen. I've seen and heard this plenty. And it seems like there's always someone predicting at any given moment that it's going to happen, but really no one can predict it. No one can predict how long it will last, and no one can consistently predict the right time to get in or out of the market. I even remember hearing and seeing a quote from Warren Buffett that said, it's not about trying to time the market, it's about time in the market. And so that is a principle that we've held on to here. And then the fourth thing is having cash set aside in advance will prevent us needing to be forced to sell when the markets are down. We've also heard Warren Buffett and many others say the key to the market is to buy low and sell high. But oftentimes human nature is to do the opposite of that. So what we want to do is have cash set aside that could be invested in our income portfolio. That way we can rely on that allocation or that portion of your portfolio to pull money out throughout your withdrawals or your distributions or your upcoming expenses, and then not be forced to sell when the market is down. Do it more under our terms or your terms as an investor. So how much of my portfolio should be invested in the stock market? Well, a simple answer. Anything that you don't need for upcoming expenses, and then as much as you can handle emotionally. And so I'll give you an idea of how we approach this with a lot of different investors, because your age, your appetite for risk, some of those things will definitely play into this. But what I want to share with you more than anything is by separating that out, that mindset of the stock market investments and then the non-stock market or the income investments, as we refer to them at Bander. And so why can't some people might say, well, why don't I just invest all of it in the stock market, like you said? And I would say, well, the simple answer is we don't want to be forced to sell when the market is down. We know that there's going to be some corrections. And even as we talk about Q3 and Q4, it's likely that we are going to experience some pullback. The numbers tell us that It will and does happen. But hopefully, this type of framework and mindset can help reduce some of that anxiety and understand that we're addressing it. And so over time, we know that the stock market has increased in value with high probability, but over the short term, it can be up and down and very difficult to stomach. So stocks tend to have big losses on average every 5 years. And so that's why we like the idea of having those expenses and that money that may be needed in the next 5 years set aside. And that's where we will use the Bander income portfolio. So as I've showing here on the slide, at a minimum for your traditional and average investor, we're going to keep at least 24 months of expenses outside the stock market. Now, that might not even mean that you're pulling money out of your portfolio, but just if you had to, or if you did, we want to understand what your 24 months of living expenses look like for you or anticipated future expenses. And then for some investors, we may even keep 5, 6 years expenses outside the market. This is definitely an individual and a customized decision. But the main thing that we're trying to avoid is having to sell during a down market. And as I mentioned, stocks do tend to drop on average every 5 years. So then oftentimes people will ask, well, what are you doing with the funds that are outside the market? And that's where we use the Bander income portfolio. This portfolio is actively managed and it includes a mix of Bander custom income notes. And hopefully you've seen and been able to review some of the information we send out about our Bander custom income notes. I'm even going to reference some of our historical data and performance in this presentation, in this video. We're also using real estate, and we even have quite a few different real estate instruments that provide good diversification, tax advantaged income, and much shorter durations and the opportunity to exit if necessary. So there's a lot of attractive features that I'm liking and that we're utilizing within the allocation or within the real estate sector. And then we're using US Treasuries, CDs, and being able to really take advantage of our platform and ability to shop throughout the United States. When it comes to the custom income notes, these are custom investments that we are producing on a monthly basis within our Bander advisory team. They have built-in protections or buffers, and so they're not exposed directly to the stock market fluctuations. And the way I like to present it is they even give us an opportunity to win when the underlying securities or the stock market is down, whatever we're using in that case. And I'll give some examples of that here momentarily. Also, real estate. I mentioned we have some investments that we're utilizing here within the United States, even some internationally. We're enjoying and utilizing asset classes like multifamily properties, industrial properties, but getting good diversification. And then the short-term savings instruments and vehicles that I've mentioned. So how do we replenish or utilize the Bander income portfolio? Well, when the stock markets are up, that's our opportunity to sell and to harvest some gains, to take some profits off the table. And then we can redistribute those gains into the income portfolio. But the goal is to fund expenses in advance and on our terms. We don't want to be forced to sell when the stock markets are down or make emotional decisions. So our philosophy on investing is to invest like an optimist, but save like a pessimist. And so, what I mean by that is over the long term, we are optimistic that the global economic engine will continue to grow and that we will invest in a big basket of global companies and US companies. And this will be done within our growth portfolio or our stock market investments. But then we're going to save like a pessimist because we know that the stock market is down at times, at a minimum, usually once every 5 years or so. So setting aside funds to ensure that we don't need to sell at the wrong time is the key. We invest and save in the Bander income portfolio. And that's where we will pull from to cover expenses. And so when it comes to the playbook for our investing model, we're going to use a globally diversified portfolio. What was hot that was this past year may not be hot next year. So instead of guessing about the future and trying to pick winners and losers, we're going to rely on academic backed research. We also know that inflation kills. So we're not trying to time the market and be on the sidelines one day and on the field the next. We don't want to reduce your purchase power. We're going to invest in stocks to help make sure that you can buy the same bag of groceries today in 10 or 20 years from now. So, if you'll remember some of the mistakes, we want to avoid the headlines, um, current events, news headlines, media attention. This can often be distracting. It's all just noise. So we prefer to zoom out and follow trends rather than getting sucked into what's trending now or what's the latest and greatest. And I'll remind you that when it comes to investing, patience wins. The most successful investors have one thing in common: patience. They're investing for the long term. There really are no shortcuts to this. Everything, those are just gambles that may or may not pay off. And so, what we want to do is stick to the core principles of investing. A question that has come up quite a bit, especially this 2024 being an election year, is what we can expect. And I thought I would share this. This gives you an idea going back to 1926, what has happened during each presidential term. And you can see blue here representing Democratic presidents, red representing Republican presidents. And really, you know what? We've had a pretty good, steady upward trend. What I'm trying to say here is that it's natural for investors to look for a connection with who wins the White House and which way stocks will go. And I understand that there will likely be a lot of headlines. There's going to be a lot of emotion that's introduced to the market, and that is common and it's short term. Regardless of who wins, nearly a century of returns show that stocks have trended upwards. So they've rewarded stocks have rewarded disciplined investors for decades through both Democratic and Republican presidencies. Please keep that in mind as we are in this 2024 presidential election. So, a couple of reminders, things for your team here at Vander Wealth Management. There are some core things that we focus on. And I'm sorry, I'm going to move back here. But the first being understanding your risk, your appetite for risk. And this will help us to know what percentage and what allocations should be in that Vander income model. Also, we're going to custom investments. We're going to put together solutions for you. A great example of this are our Vander custom income notes. We are creating those internally. We've been utilizing them on behalf of clients, and it is something that we do that's different from many other investment groups or firms. And it's something that we can bring to investors that I'm very pleased with. We are very diligent when it comes to cost. We're utilizing low cost investments and understand that that affects the overall fund performance. One thing that I love doing as a certified financial planner is not only focusing on the costs, but also your tax efficiency. We love working in conjunction with your tax professionals. We certainly seek to understand the tax implications of the things that we're doing on our end and really utilize tax advantaged investments on behalf of investors. And then is to stay fully diversified. So those are some of the things that I wanted to bring up with you today. Our portfolios are actively managed, which means that we are rebalancing as cash comes in, as things happen within your portfolio. And I'll mention this when it comes to the general rule of thumb. Please remember, we don't want to use long-term investments with short-term money. So that's again why I remind you of the growth portfolio and then also our income portfolio, which is where we'll pull from for short-term money. Now, as a matter of update, this is in regards to that growth portfolio and some of the investments that we're utilizing inside the market. And you'll see we have an index fund, the S&P 500, that represents the 500 largest companies in the US. We also have made a transition and are using more of dimensional funds. And I'm going to touch on that here momentarily. But two of the funds that we're using, one is a high profitability, which invests in 182 US companies with higher than expected profitability, good, solid profit and loss statements and income. And then the other one is a value fund that invests in smaller and mid-sized companies, over 1,300 US companies. So it gives us a lot of good US exposure. We do have a sliver or an allocation into the energy sector. So that's represented here with a low-cost ETF. And then the last one is to use a total international fund. And this is one that we're pulling from Vanguard that invests in over 8,600 non-US companies across the globe. And so that gives us some good international exposure, some opportunity for return, and helps with manage that risk and give us some diversification. Now, dimensional funds, one thing I like about them is that they really don't jump on every new idea that comes along. They're looking at what will stand over a long period of time and really looking at the fundamentals of each of the businesses and the companies that are within their funds. And that's a big thing that we preach here at Vander Wealth Management as well. And so that's why we've inserted a couple of their funds now into our growth portfolio. When it comes to the active models that we supervise, many of you have likely seen this, but we have a scale of 1 to 6, 6 being aggressive growth, pedal to the metal, 1 being more protection and more conservative. And so we have each of our portfolios based on the investor, based on your type of account, but assigned to one of our active models. And what within each of these models, this gives you an idea of what percentage is going to be in that growth or stock portfolio and what's going to be in the income portfolio. And so, for example, with model 1, we're going to have 60% into that growth, the income portfolio, where we've got more aversion to risk for that more conservative investor. And then as you slide down the scale or up to the Model 5 or the Model 6, you're going to see more exposure to the growth or the stock market portfolio. So we're always happy to dive into this in greater detail with each of you individually and one-on-one, but that gives you a general overview of what the differences are between the models 1 through 6 and how they're allocated between the income portfolio and the growth portfolio. And one thing that we'll find common with investors is we might have a Roth IRA or a longer term vehicle that is invested in the Model 5, and then a different account or an account that we plan on utilizing sooner in your timeline that's invested in the Model 2 portfolio. So there's great options here and something we've been very pleased with. Now, this here gives you an idea of our custom income notes. We now have invested close to 73 million into these types of investments at the time of this recording. And I want to share with you a little bit of the returns. Once the coupon or the dividend, the income payments, the cash coupons that come out on a monthly basis, we've received 90% of those payments. So you've probably heard me say before, that tells us 2 things, that number 1, they happen with a high level of frequency, but number 2, there are times when one of the underlying securities is outside of the buffer, and so it therefore does not pay that month. We've had an average annualized return over the 5 portfolios of 16.14%. And you can see our model 3, 4, and 5, they have higher annualized rates of return. They've taken on more risk within these income notes. And so that's to be expected. And then we have had 100% of the principal returned on these notes to date. And so very pleased with the performance of these. These are a huge part of our income and our Vander income portfolio. So a couple things now as we come to the conclusion of this video, I want to mention our year-end strategic financial planning sessions. We as financial planners look at 5 key pillars and components of a plan and work we do as certified financial planners. And the first is to start with the estate planning. We want to understand what your goals are at the end and what you're working towards. So this is something that we have been incorporating. We plan and expect and want to talk to each of you about it. We will then move through this life cycle, if you will, work on tax planning, certainly from our standpoint, but also working in conjunction with your tax professional. It's also very helpful for us to have a copy of your tax return. We can run through and do our own analysis from a certified financial planner standpoint and provide some additional insight and perhaps some tips or recommendations on things you can be doing from a tax planning standpoint, not to mention our emphasis as a firm on tax advantaged investments. It then moves through and goes to insurance planning, income planning, and investment planning. And so you'll notice the income planning is where we use our income portfolio, and then the investment planning is going to be that long-term growth strategies. So a couple things, takeaways from this video. If you haven't received it already or would like a copy, we've created a list of 35 essential documents that we want to make sure that each of our clients have. We encourage you to put together these documents. You can upload them onto your Bander Secure financial website in the vault, where they're stored securely and free from theft or being lost or damaged. So, but we will send this to each client. When it comes to tax planning, as I mentioned, we love working with your current professionals. I always invite clients to open up a line of communication with us and your current tax professional. There are things that we can do in working alongside each other. And then providing us a copy. We will run through some tax scenario analysis. We'll look at last year, we'll project for next year. It'll help us make investment decisions and conduct great and extensive financial planning on your behalf. It also will help us to help you minimize your lifetime tax liability. So we're looking at Roth conversions, we're looking at our contribution schedules and our distribution schedules to see what might work best and most appropriately for you. Now, as I go through that progression, you'll remember insurance planning was next. And a key component for us and what we're doing with clients is long-term care planning. So we want to make sure and include this with you. If you have questions and want to reach out in advance, please feel free to do so. But we have 5 areas or ways that we address long-term care planning that do not involve a long-term care policy. We shy away from using long-term care policies. We feel like there's 5 options, and it's not that everyone is going to utilize one of these. It's usually a combination, but we want to make sure that you have a plan for long-term care. Many of you have likely seen it with your parents or loved ones, and we want to make sure that you have a plan in place. And so we do have some solutions, and we'll plan on covering these things with you as part of our ongoing financial planning with you and with our clients. A good quote that I read the other day by Benjamin Franklin: "Wealth is not his that has it, but his that enjoys it." And one of our goals here is to help you enjoy the wealth and the money that you've built up and saved over the years. So please know you have myself, Doug Omont, a fellow CFP and member of our advisory team here at Bander, more than willing, looking for opportunities to help and to contribute to you and to your happiness throughout retirement. Please know that you have a professional team here at Bander Wealth Management, ready and able to serve at all times. And I would like to just say thank you. Thank you for the opportunity to work together, to work with you. And please know that our goal is to help you accomplish your goals. We appreciate those that have referred us over the years. We are open to receiving your introductions. If you have friends or family that could benefit from some of the solutions that we work diligently on acquiring and then applying and helping with our investors. So we thank you for introductions that you make to others that might benefit from our services. If we can be of service to you in any way, please don't hesitate to reach out. And I hope that you found this video useful and educational, and look forward to talking soon. Thank you.